ultimately what happens if there's no limit on your debt issuance system, you end up with this leaning tower of debt, which is on fire. And I think that's what we're starting to see now. It's the most credit unworthy borrowers in the high yield market, where we see the yields are now surging. Interesting, Bloomberg gave a warning about that last week. I mean, it was clear, and it was in much worse shape about 2 months ago, but it took a dip in terms of the yields in the junk bond market, and then they've just started to turn up now again. But it's, rigging the price of gold and silver gives you the ability to blow bubbles.
Tuesday, May 27th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today I have the pleasure of speaking with David Jensen from jensendavid.substack.com. David, welcome back to the channel.
Thank you, Mario. It's great to talk again.
Yeah, same here. And I want to jump right in and talk a little bit first about the ECB. They came out, I think it was exactly just over a week ago, and
Yeah.
they warned the world of like a crisis, financial crisis that could evolve from, and I quote them, additionally, disruptions in the physical gold market could increase the risk of a squeeze and a financial market crisis. And I always follow your writings on Substack, and I recommend the viewers to follow David. And you wrote something about this, and I was interested with the term that you used. You say that it's the ECB's limited hangout warning about gold and financial market instability. And I thought, David, it was a strange thing for them to warn. And I even replied to a tweet by someone here, and I'll share this with you and the viewers quickly before I'll let you take over. He said, "Let's break the ECB." And he retweets this tweet by Gold Telegraph or Post about the ECB. And I replied, by market participants, they mean the bullion banks. I hope they get their comeuppance. And you've kind of explained to me why they didn't use the term bullion banks. So, yeah, tell us about what a limited hangout is and how it pertains to this ECB warning.
Yeah, it comes historically from the intelligence side of government, and it's a public tool that they use, to create a controversy about a topic. But you either create a controversy about it to distance yourself from the controversy, or you raise attention to a fact that's of a lesser concern than the primary issue that you're trying to hide. So, you identify a lesser evil, and then you talk, endless terms and controversial terms about it to spin things up. And it's also used in the political spectrum as well to get away from scandals. So yeah, and I saw elements of that in the ECB's um, release there in their financial stability review that was released there the middle of last week. Even the title I thought was somewhat disingenuous. It said, "What does the record price of gold tell us about risk perception in financial markets?" And then when you look at the guts of the 5 pages of the financial stability review, I mean, they were really highlighting the risk to the markets of this, $1 trillion of over-the-counter derivatives that they said were, such a tremendous risk to the financial system. So, you know, it is interesting they've chosen gold to write about. I mean, there's a quadrillion or 1,000 million, sorry, 1,000 billion of interest rate sensitive derivatives in the market. And then for some reason, gold is the big risk, with a derivatives market that's 1,000th the size of the other financial instruments. So yeah, so essentially what they do in this paper is they talk about these OTC derivatives, that they're opaque and that they're leveraged, and that if people ask for gold against the derivatives, they can blow up the banks. And there's they use keywords like vulnerability, concentrated leverage, opacity, and they're heading in the direction of, we need more regulation is the ultimate theme of this, as well as warning about these gold derivatives. But the key thing, Mary, is you and I have talked about in the past, is that the most important thing about the rigged gold and silver markets um, in the city of London, you know, which was created ultimately by the Bank of England to mitigate price movements, to control the price of gold and silver, is the fact that they trade in these spot contracts, which are largely unbacked. So they're claims for metal that doesn't exist, and that's the key issue, right? This is the biggest OTC market in the world. The ECB is warning about OTC derivatives, but in the gold market, the LBMA says that only 10% of the daily trade in London is in OTC derivatives, and the other 90% is in the spot claims for metal that doesn't exist in the gold and silver market. And the size of the standing claims in the market is somewhere between 400 and 600 million ounces of gold and 5 to 8 billion ounces of silver. That's the key risk, but the ECB never even mentions this. Well, first of all, they don't say where the OTC market is, which is in London. They just talk about that they are in the markets globally, and that they're unregulated, and that they're opaque. And then they just kind of, drop the ball at that point and then go on to discussing other matters.
Yeah, that's right. They never mentioned the LBMA. And you also said that they differentiate between the forward unallocated OTC and the spot, but they're all the same. They're all promissory notes. And the thing is, David, that back in January was January 29th. There was that article in the FT, and I won't forget that article because that's when they warned
Yeah,
the first time that there was a 4 to 8 week delay for spot delivery. And
yeah,
it seems to me that the ECB is trying to cover themselves because
right.
they can see something happening in this LBMA Ponzi. And I had a look before we started, and I noticed that gold was up 5% last week. I didn't
Hmm.
look at the price on Monday. I think gold was slightly down, but most of the
Hmm.
market was shut in the US and the UK. So do you think that could have been partly a reaction to that? That people in the know or people high up in the central banks, they saw this warning by the ECB and they reacted. And the other thing I'd say before I let you chime in again is that they came out on Monday, I think it was last week. They warned about this, and then they said our full report is coming out like I think Wednesday,
Right,
right?
right, right. Yeah, I mean, the story for me really started at end of December, beginning of January of this year, with the withdrawal of large amounts of physical bullion from London. And so the market was already voting with its feet. And so the ECB X Post comes out and writes this letter because I think that the market has been exposed in terms of the Bank of England having to lease metal into the gold market to cover up for the shortage, and that you would still have to wait 6 to 8 weeks for delivery of gold and silver. And the silver lease rate is still higher than it has been historically. So clearly, I don't think this problem is going to go away. I think that natural systems, they kind of, swell and ebb, and these problems come in waves. And I think what they're trying to do is kind of plant the flag here in terms of it's almost like they had a list with boxes to check of things to warn about. And the only box that was missing was the single most important item in the world's single largest gold and silver market, which was the spot contracts, which were created by the Bank of England to be what they were with their oversight of the LBMA starting in 1987. And so it seems to have the kind of the classic markers of a limited hangout that you talk about everything except for the key item in terms of trying to um, paint yourself as, say, virtuous and laying the groundwork for saying these are, bad, unregulated party to party markets, when in essence, the central banks are the regulators. And it was the regulators who lost their minds, who were seized by these animal spirits and created these dangerous contracts, which have led to the suppression of the gold and silver price by creating artificial supply, and consequently have led to the biggest debt bubble and speculative asset bubble in history. And this is directly connected to the ECB, Bank of England, the Federal Reserve, the Bank of Canada, all of these Bank for International Settlement or BIS
The Bank of Japan as well, I
members.
guess.
Say again?
Bank of Japan as well.
Bank of Japan. Yeah, they've all participated in this. And so we have the regulators are the ones who destroyed price discovery in the markets. And then the regulators then went about blowing the biggest debt and asset bubbles in history. And here we are. And now, the game is clearly to avoid the consequences.
Yeah, and viewers might ask, why would the central banks, who are the regulators, want to do that? And the reason why, David, is because gold is like a barometer of monetary rectitude. So if the gold price is under control, investors remain confident about the
Yeah,
system. Uh,
yeah.
but now things, with what gold has done the last 2 years, and hopefully, and I think silver will as well do soon. Uh, Maybe this is a signal. It's an alarm about the system. And before we started, you asked me what I thought about the markets, and I said the markets in general, and you said yes. So maybe you could talk to well, tell us what you think is going on. I mean, what you speculate is going on, and how
Mm.
important gold is as a barometer.
Yeah, it's a good point. Alan Greenspan, who was the head of the Federal Reserve, was clear that the price of gold was one of his primary indicators of inflation expectations. And he used to wax on about inflation expectations being controlled and justifying the blowing of these, systematic blowing of these bubbles by the Federal Reserve. Um, I mean, the dot-com bubble there in 2000 that popped shortly thereafter, the turn of the year. I mean, he said it was the internet that was leading to permanently better returns in the market, nothing to do with the Fed, but in reality, it was the Fed's loose money that they were operating. So, the price of gold has both been an indicator and a cover for this loose monetary policy that has been utilized by these central banks to create this debt bubble nirvana. And ultimately, what happens if there's no limit on your debt issuance system, you end up with this leaning tower of debt, which is on fire. And I think that's what we're starting to see now. It's the most credit unworthy borrowers in the high yield market, where we see the yields are now surging. Interesting, Bloomberg gave a warning about that last week. I mean, it was clear and it was in much worse shape about 2 months ago, but it took a dip in terms of the yields in the junk bond market, and then they've just started to turn up now again. But rigging the price of gold and silver gives you the ability to blow bubbles and to create debt without limit when you can create gold without limit, and that's what we're seeing now. Is that the consequences we have total debt in the system relative to GDP is more than twice the historical norm. We're starting to see price inflation running over the last few years. And then in the middle of this storm, which has been created by these regulators, the central planners, we have the unfelicitous withdrawal of silver bars from London by US parties that have lifted the veil on this rigging system. And I think it's only going to get worse in terms of individuals asking for physical delivery. And the ECB report alludes to that as well, saying that they expect it to be a significant factor in the markets, which can, in the end, create margin calls on those who have sold what they don't have, which is these bullion banks selling these spot or cash contracts for immediate gold and silver delivery into the London market.
I would be very concerned if I had any dealings with these banks in terms of gold and silver, unallocated, even allocated. I think we're going to get to a point where they'll have to renege on all these promises. And
Yeah,
the other thing I wanted to ask you, uh, do you think as the government bond market comes more and more under pressure, we've seen the 40-year JGB yield run
yeah,
up from like 2.6 at the beginning of the year is now 3.6 almost.
yeah,
A few years ago, all the maturities in the JGBs were negative. And we're seeing U.S. Treasury yields go back above 4.5. UK gilt yields are higher. Uh,
yeah.
do you think, because a lot of people still think that yields are going to go back down to zero, but I personally don't see that. And I personally think gold is telling us we won't.
Yeah, absolutely. You cannot lower interest rates when gold is running the way that it is. And I think if we look, I mean, the interest rates that have risen now, use the round number of 5%. I know it's like 4.5 for the 10-year treasury note, but using a 5% interest rate, the total issued US debt in all sectors of the economy is $102 trillion, according to the Fed. I mean, the federal debt is 38 trillion, but the total debt is 102 trillion. And just the 5% rise in rates to date, with time, as the debt is rolled over and resets to the higher rate, it adds a $5 trillion burden, to a $28 trillion economy, and it's just not sustainable. So the debt party created by the regulators at the central banks was a lot of fun for them and for people in the financial industry who benefited from these asset bubbles which were being blown. But now, the worm has turned, and the consequences of this loose money and the massive amount of debt that was issued are coming home to roost, just as it did in 1929 when the debt became unbearable for the economy as they tightened up the money supply. So here we go.
Yeah, so I guess what we're going to see is a reversal over the next decade or even 2 decades of the 4 decades of financialization that we had seen from 1980 to 2020, for example.
Mhm.
And I don't think many people are ready for it, David, because I saw a post yesterday on X. I think it was from Incremento AG and Gold We Trust, and they had a bar chart of where family offices or big wealthy families were putting their funds, and it's still focused on stocks and bonds, the 60/40 portfolio, private
Right.
equity. They've only got like 2% in gold miners and
Yeah.
silver, and only 1% in commodities. And I expect general commodities to do relatively well because in the age of financialization, yeah, commodities have been, in my opinion, heavily undervalued. Is that the way you see things too?
Yeah. I mean, the challenge is that through this leverage of paper, um, as you call it, the financialization, but just this creation of endless amounts of claims in the system, is that we're now getting to the point now where it's clearly unsustainable. And you just have really the toe of the flood or the toe of the wave has started to move into the physical gold market. And it's enough to have the ECB come out and kind of breathlessly give us this warning about a secondary or a tertiary issue in the gold market. But clearly they feel a need to give voice to something to try to give themselves some cover. But I don't think it's going to work. I think it's just it's too clearly evasive in terms of avoiding the central issue, which is the regulators themselves rigged the markets with leveraged gold and silver claims in the London market, and it's led to the pain that we are now going to experience.
It's interesting you use the analogy of the toe of the wave. And having grown up in Brazil, and as a kid, I went to the beach and I thought I could swim better than anyone else. And I used to go body surfing, and then you go into those waves and it's dangerous. One time, someone had to swim out to get me. So maybe the ECB is trying to warn the banks, be careful because yeah, this could be deadly, so to speak, this situation in the OTC or LBMA.
Well, they've let it go on for approaching 40 years now, and the situation in the gold and silver market is not retrievable. And so I think what they're going to see here is they're going to try to vilify derivatives and non-regulated trading, and especially gold and silver themselves, um, in this environment here, and they're laying the groundwork for it.
Yeah. When I,
The issue is never the gold and the silver. The issue was the people who created this false market and the unlimited number of claims for non-existent assets that were supposed to be there.
yeah, it's like a burglar warning that there could be a lot of burglaries in a neighborhood.
Yes,
It's really amazing. And the BIS, Bank for International Settlements, David, they're supposed to be the world regulators, and the
right.
and they sometimes come out with warnings, and they these crises that they warn about usually happens because they're the ones who caused it.
Yes. I
Yes.
know the BIS is insiders club, and talk about unregulated with zero transparency in terms of their meetings. And all the world's major central banks belong to this central bank of central banks there in Switzerland. Um, it's really quite amazing. And when you look at the founding of it, how the American people were dead set against the creation of the BIS, and that the Rockefeller and Rothschild bankers essentially financed the shares, the American portion of the shares as private entities in order to create this structured entity, which the American people didn't want. They'd had enough after the first and second Bank of the United States blew up and raised havoc in their society. They didn't want that, and it looks like they were right.
That's right. And so, what would you say as a final warning to the viewers about the gold and silver market? whether ETFs are safe, whether dealing with the bullion banks is safe. Of course, I know what you're going to say, but a lot of the viewers haven't listened
Yeah.
to you before.
Well, I'd say there's unlimited leverage in the gold and silver market, in the cash market, which is the key issue, which is what the ECB and the BIS aren't talking about because it was their creation. Number one. Number two is that because of these bullion bank claims that the bullion banks have sold into the market. If you take like in round numbers of a 500 million ounce short position um, in the physical market, never mind the issue of default, but if you just look at the liability that can be created if you have rapid one, two, $3,000 movements in the price of the metals, you can quickly rack up $1 trillion or more of liabilities on your balance sheet, which essentially blows up the banks. So, and that also, given the fact that such a small percentage of people's savings in their banks is held in the cash form by the banks, um, I just don't see financial instruments as being a place that a person wants to be right now. Certainly not something run through the banking system, given how unstable it is. And the fact that we could see a tremendous crisis, I think we will see a tremendous crisis coming out of this, let's call it a resetting, but basically a exposure of the fraud in the London gold and silver market. And I gotta add, this is not financial advice; it's just my personal opinion. But this is not the time to be sitting with assets and brokerages that are dependent on bank accounts, right? I liken holding gold stocks to having a lifeboat inside the Titanic if you're holding gold stocks through brokerages because of the tremendous leverage and the risk that the systemic risk that has been created by our regulators.
Yeah, so it's not even just the risk of having a claim like an ETF or OTC claim on gold. It's also
Mhm.
just having, even if you're not involved in the gold market, just having a lot of savings in a bank for that matter could prove very dangerous. And the thing is, a lot of the major banks are the ones that are heavily exposed to to these derivatives and
Mhm.
ma banks like JP Morgan and so on, and
Right.
that could bring I mean that could bring everything down. I mean
It
it's
could. David Rogers Webb has been speaking out about this problem as well, in terms of the fact that um, not only are your assets at risk, but the next time that there's a financial crisis, the system is designed to sweep the assets out of private accounts into the hands to keep the bankers whole. And Patrick Byrne was warning. He was the former CEO of Overstock.com, and he was warning in 2007, 2008. I think he spent a couple of years in the halls of Congress warning about this exact problem, and that the assets were not you didn't have a direct ownership of the assets. You just had a claim on the assets, and that there were other people that were being put first in line with claims on those assets that were in these investment accounts. So yeah, it's not just you and I that are seeing this. It's been
yeah.
a chronic problem, and it's a bit of an epidemic right now that's breaking into the open.
Yeah, I mean, you even mentioned the gold and silver miners. I mean, th there is a risk, like you say, of the broker. Let's say they have an account with JP Morgan or
Right.
they go under. It would take a while to get claim back of your mining stocks. That's why I personally, I mean, everyone has his or
Mm.
hers risk management or risk profile. But yeah, I do have mining stocks. But if something like that were to happen, I wouldn't. Yeah, it wouldn't be nice, but I would be okay. So that's the way to look at it. It's a
Yep.
risk reward situation.
One of the options that people have that is probably not widely realized is that investors can take direct delivery of the share certificates that they hold in brokerages, right? So it is an option for individuals if you want to take out the intermediation risk
Yeah.
of holding the assets in a third party.
Is that, would you say that's available everywhere? Like, let's say in Canada,
In
UK?
Canada, it is. It
Yeah, I'm not
takes
sure in the
it's
UK
like
do it.
$50 to get a share certificate, and maybe 4 to 6 weeks, and you get the share certificate from the miner
Yeah. What
in
if
a
you
paper
wanted
form.
what if you wanted to sell would you have to send it back to the broker?
Yeah, well, you would take it into your bank, and then in about 2 or 3 weeks, it would appear in your account. So they would they would submit the share certificate, and it would be canceled, and it would show up once again as an electronic
Yeah.
element in your account.
Yeah, maybe that's something for people to check in their different like jurisdictions because I'm in the UK. Maybe I won't talk to my bank because
Mhm.
my brokerage account is not with my bank. But
Mhm.
yeah, people need to check that out. David, thank you very much for your time. We're going to keep an eye on things. And
Yep.
yeah, it would be nice to have you on again soon. And all the best.
My pleasure. Thank you for your time, and yeah, we'll keep an eye on who the next party is that's going to give us late warning.